Welcome to the deep dive. Today we're plunging into something fascinating, the world of trillion-dollar sovereigns. This is a new economic order, really, defined by the, unprecedented power of these mega-cap companies. We're talking about Alphabet jumping into the $3 trillion club, joining NVIDIA, Microsoft, Apple. And it's not just about market cap, it's actually reshaping global markets. It's influencing private capital. And even drawing some pretty clear lines about who gets to issue currency. Our mission, like always, is to pull out the key insights from the sources, give you that sharp, informed view on this huge concentration of value and, power. Okay, so let's explore this elite group. NVIDIA, Microsoft, Apple, Alphabet. It's almost breathtaking how fast things move. NVIDIA actually soared past $4 trillion back in July.
Yeah, it's incredible. And what's truly mind-bending here isn't just the size of the valuations, it's that they seem driven by what some analysts are calling a great earnings schism in the market. Think about it like this. These companies aren't just, outperforming slightly. They seem almost structurally designed to churn out superior financial results. They're playing a different game. So take Alphabet, for example, trading at about 23 times forward earnings. That's right in line with its own history. It suggests this isn't just speculative froth, It's backed by really consistent, dominant performance.
That earnings schism phrase, that really hits it. It highlights how unique they are.
Mm-hmm.
And if their individual values are impressive, wow, the combined picture, their collective scale is staggering, right?
Absolutely. It's truly enormous. If we connect the dots, the combined market cap of just those four, we're talking roughly $14.69 trillion. Now, get this. That collective value completely dwarfs the entire public stock markets of major nations. It's bigger than China's market, more than double Japan's. It even beats the UK, France, and Germany combined.
Wow. That's hard to even visualize.
It is, and it leads to this diversification paradox for investors. Imagine you think you're playing it safe, broadly diversified with an S&P 500 ETF. But then you realize nearly 40% of that fund is concentrated in just 10 U.S. tech giants. So your diversified portfolio, it becomes, kind of by default, a really heavy bet on one specific sector.
That comparison to whole national economies is stark. Really makes you rethink market power today. So,
Yeah.
Okay, what's the ripple effect then? What are these titans doing to, say, private equity and venture capital?
That's where we see what's being called the Great Divergence. Picture private equity, right? It used to be sort of one thing. Now it's splitting. You've got these huge mega funds chasing assets so big they're practically public companies already. And guess what? Their returns are starting to look, a lot more like public market returns, less spectacular.
So the big money gets blamed to returns.
Kind of. And then you have the smaller PE funds digging deeper into the lower middle market. They're still hunting for that real alpha, trying to significantly beat the market. Meanwhile, the whole venture capital world, it's facing what some call an exit crisis.
An exit crisis, meaning...
Meaning the traditional way out for successful startups getting acquired by one of these tech giants is getting much harder. Regulatory scrutiny is way up, blocking those big M&A deals more often, and that threatens the liquidity, the cash out moment that really fuels the whole innovation engine for startups.
Okay, so massive power, huge market caps, disrupting private capital. It makes you wonder, could they take the next step? Could they issue their own digital currencies, like stablecoins? What do the sources indicate there?
Well, consensus seems to be that the likelihood is exceedingly low. Really, really low. Just think back to Meta's Deem project. That wasn't just a failure. It was a spectacular, very public regulatory smackdown.
Right, that crashed and burned pretty hard.
Exactly. And it served as a huge warning sign. You've got insurmountable global opposition now. We're talking the Financial Stability Board, the G7. Basically, every major watchdog is saying, no way. Plus, deep bipartisan political hostility, certainly in the U.S. It's just not worth the fight for them. Their strategic preference, it's very clear, is for lower risk, higher margin businesses.
Like being the platform.
Precisely. Platform and infrastructure. Apple acts as a neutral distributor, right? Google and Microsoft provide the cloud backbone. They make huge profits there without wading into the politically explosive, heavily regulated business of issuing money.
So it's less about can they, technically, and more about why would they risk it? They'd rather just provide the rails.
That seems to be the strategic calculation. Yes, their advantage lies elsewhere.
Okay, this deep dive really shows a unique economic moment we're in. For you, listening in, our informed learner, what are the key takeaways here?
I think first, investors really need to recalibrate. Understand that market cap weighting now brings active concentration risk. Diversification isn't automatic. And for corporate leaders, you probably need to find smart niches or ways to build on these platforms. Competing head-on looks extremely difficult.
And maybe a final provocative thought to leave you with. The future for digital payments, for stablecoins, it's definitely bright, but it's far more likely to be shaped by focused fintech firms, maybe the existing payment giants evolving, the trillion-dollar sovereigns. They seem to have drawn their lines pretty clearly. Their kingdom is built on data, on computation, not on trying to invade the sovereign territory of money itself.